Friedberg, let's go to you next and just talk a little bit about what's going on in Japan, because they have had a rush of people buying their stocks, the population declining. It's a very unique economy. Maybe you could talk a little bit about it.
One of the biggest challenges facing Japan is the level of debt that they've accrued. Their debt to GDP ratio is currently 263%. They have about 1.3 quadrillion yen of public debt on an annual GDP of about 591 trillion yen. They're currently at the federal level spending about 20% of GDP per year. 5% of GDP is being spent per year just on servicing the existing debt. And that's at interest rates set by the central bank of roughly 0%. So, or whatever the market is trading it at, so slightly above 0%. But if the central bank had to start to raise rates because inflation started to run away because there's so much yen in circulation, there's so much debt outstanding, the federal government would not be able to actually service this debt. So as of March of 2024, the Bank of Japan, the central bank, actually holds 53% of Japan's outstanding government bonds, which is equal to about 100% of Japan's GDP. So their central bank has bought the debt that's being issued by the federal government to fund their budget, a large chunk of which right now is being spent just on paying the interest on the debt, while interest rates are close to 0%. So imagine if interest rates bumped up to 1, 2, 3, 4, 5%, as we're seeing with US Treasuries. We were recently at a nearly 5% handle on the 10-year Treasury. It would become an unsustainable debt burden for the Japanese government to be able to handle that. And a large part of this is being driven by a number of crises that Japan has faced since the early 90s. So there was the financial crisis in '08, there was the nuclear meltdown, there was a couple of earthquakes, tsunamis, and a lot of debt has been taken on to support the country after those crises. But really importantly, and Nick, if you could just pull up this age chart, is the aging of the Japanese population. So this chart shows that, and you can kind of see back to 1950 when the average age in Japan was 21 years old. And today, the average age in Japan is around 48. In the next decade, it'll be 50. Then it'll be 52. So that means more and more people are relying on public pension. Today, 33% of their government spending goes towards their Social Security programs. In the US, for comparison, Social Security is about 20% of federal spending. So that number is only getting bigger and bigger. As the population ages, the Japanese government has to continue to service their older population, and they've had to face several crises. Their debt has ballooned to a level that is well beyond any other industrialized nation. And the only way to continue to service that debt economically is to keep interest rates low. And the problem with keeping interest rate low? Inflation. And that's the big driver that caused them to say, let's uptick the interest by 15 bips or 25 bips, is to try and tackle the inflation problem they're facing, just like our central bank recently tried to do the same. But clearly the market can't have it. So Japan is in a real pickle. And I think that it shows how much having a large amount of federal debt can impact the ability for a nation to maneuver itself during difficult times. And ultimately, debt payments come due. They come due either in the form of economic contraction or massive taxes or inflation. And currently, Japan is paying for it in terms of inflation.
Sorry, you're saying Japan has inflation? Japan has no inflation.
The government raised rates to tackle inflation. I'll pull up the inflation chart. Japan's inflation hit a 40-year high, and this just shot up in the last 18 months. Inflation is running at close to 4% a year.
And so they're setting, Friedberg, the interest rate in the country, and they own the debt. So they're basically in control of, or they're manipulating the economy and trying to control it. Correct, Friedberg?
Well, their central bank has to buy most of the debt, and their central bank sets the rates. So they have a large amount, 53% of their public debt is held by their central bank.
And if they don't pay a high interest rate, then people don't buy future bonds. If they do raise it, they have to pay that rate. So this is the conundrum, Friedberg, if I were to summarize it.
Well, yeah, while rates are low, you see this, particularly in a market like we're facing today, where there's global inflation. They need to raise rates in order to reduce inflation. The problem with raising rates is this currency problem.
But also buying the debt, Chamath, is like who's buying debt if you're not getting anything on the coupon, correct? That's another challenge they face in Japan is that.
There's a famous quote from an economist, Simon Kuznets, who said there's four kinds of countries in the world. There's developed countries, undeveloped countries, Japan, and Argentina. And I think the reason he said that is that Japan has been in this state since the 90s. So they had a massive property and equity bubble collapse, and they've not had to deal with anything that looked like typical economic issues since then. And part of it is because the government plays a very big hand in the Japanese economy. There's a lot of price controls there. So I don't know. I'm not sure what it is that we can learn there that you can extrapolate to the rest of the world.
Yeah, it is a very unique Sachs geography and economy. So, Sachs, your thoughts on this overall and what we can expect? Maybe you could take the future-looking, forward-looking, and prediction crystal ball. Go ahead.
So I think Friedberg is right that the reason why the Japanese central bank tried to raise rates, I mean, just by a tiny amount, was because they are dealing with inflation. If you look at that inflation chart and you go back to when their inflation was zero, roughly in 2020, the exchange ratio between the US dollar and the yen was about 100 to 1, meaning one US dollar could buy 100 yen. Now it's at roughly 150 yen to the dollar. So their currency has massively depreciated over the last several years. And a big part of the reason why is because, again, their central bank is offering roughly zero, and you can earn 5% in US T-bills. So people are basically moving their money to countries that pay a lot more on their bonds, and they're even borrowing yen, like we talked about, selling the yen to then buy Australian dollars or US dollars to invest the money there. So there's huge downward pressure on the value of the yen. And the way this creates inflation is that Japan is obviously an island that has very few natural resources, and it has to import all of its oil. So it has an advanced economy, but it needs to import a lot of resources. And so as its currency depreciates, the price of all those commodities goes up. And this is why you're seeing inflation in Japan. Now, when the central bank tried to solve this, it created huge jitters in the financial market because it was starting to unwind the whole yen carry trade, which is something like $20 trillion.
Wow.
And so the Bank of Japan backed off. And you heard the Japanese central banker said, we can't raise rates while it would create instability in the global markets. We have to wait until it's stable. But the problem is that raising the rates and unwinding the yen carry trade creates the instability. So what they're saying is we're never going to be able to raise rates. And the result of this is going to be more inflation in Japan. Their currency is going to continue to depreciate. They've been unable to defend it. And so what I would expect is that the US dollar is going to keep buying more yen. It's going to go from, 147, 150
There
to
is one,
some bigger number.
it's one huge upside to this. Sachs.
And who's going to pay the price here is the Japanese consumer, because everything's going to cost a lot more.
Yeah, and that was, obviously when you get 158 yen to the dollar, this is extraordinary. I was talking with Tucker, and we just took our Niseko ski trip this year from 4 days to 7 because it is just such a great deal. So
It'll be good for tourism because, you'll be able to travel to Japan much more cheaply.
Amazing.
But if you're actually Japanese and you live in that country, you're going to see your purchasing power continue to erode. So I would expect big domestic problems in Japan, and eventually they may conclude that this system does not benefit them. Now, who does it benefit? You could argue that it benefits the United States because it has subsidized the purchase of our debt, right? Because again, so you have this yen carry trade of 20 trillion, and a lot of that has gone into US bonds or US T-bills, right? And so It basically is a huge subsidy to the US Treasury's need to continuously issue more and more debt. We're issuing, $1 trillion of net new debt every 100 days. So having the Japanese consumer subsidize all of this by taking it on the chin, in terms of inflation, in order to provide this yen carry trade, you could argue has been very beneficial to the US Treasury.
And Chamath, at some point, the percentage of your debt to GDP, we've talked about it so much on this show. You've said previously, hey, we can have a little bit of this because we're a very strong dollar. So when you look at Japan, is there some lesson here for the US or, maybe some warning here that we shouldn't necessarily follow them too far down this road?
Nope.
Okay. Keep printing money. Got it. Okay.
Well, I don't know. I mean, I tend to agree with Freeberg here that when you have massive amounts of debt, it definitely limits your flexibility.
It's just
I mean-
arithmetic. You're going to pay for it with either economic contraction, higher taxes, or inflation. Those are the three places it goes.
Yeah. And they did test it. They've stress tested now. Yeah.
One of the reasons why Japan can't raise rates is because their debt will become even more expensive. Right? I mean, Freeberg, isn't that part of the problem?
Yeah, that's exactly right. And then their federal spending gets compressed because now they have to service that debt. Again, they're already spending 25% of their federal budget on servicing existing debt with the low interest rates. And they've got to support an aging population.
Okay, so to analogize this to the U.S., our debt service costs are what are they at now? Like well over $1 trillion.
We're about $1 trillion a year with a proposed $7.3 trillion budget. So we're at 13.6%. And Japan's at 25%.
Over the next 10 years, isn't our debt service supposed to rise to?
Yeah, as all of the low interest bonds mature and we issue new debt at a higher interest rate, our debt service cost is going to continue to climb. It's already higher than discretionary military spending at over $1 trillion a year.
Well, just buy Bitcoin, and when it goes to $1 million a coin, we can just pay it all down. So problem solved.
Just one other point is, I think it shows the fragility of the global financial system. I mean, the markets snapped back as soon as the Bank of Japan backed off, basically capitulated, said, "Okay, fine, we can't defend our currency. We're just going to let it keep depreciating. We're going to let inflation keep raging." As soon as they declared that, then the market snapped back. But it just showed in that 24 hours, putting aside like all the panic porn that was on social media, because I think that was overdone, it still showed how fragile the global economy is. The yen carry trade has injected roughly $20 trillion of liquidity into the global economy, and that is propping up all sorts of things, right? And that is subsidizing U.S. government debt. And you just wonder if the yen carry trade were to end, because let's say, for example, the Japanese people don't want to experience hyperinflation, then what would that do to the global economy? It just showed how rickety the whole system is.
I think it shows how much leverage there is in the system.
Totally. That's what it is. It's all about leverage.